Hey, you can hear me? My music might be too loud. All right. Well, let me try to explain a little bit of what I'm looking at. Um, this this number here is where I enter the trade, and this is where my stop loss is at. Um, I'm expecting this trade to come up to here. That'll be the end of the trade. So I place my take profit there, and this is just a demo account. This is an account that I get on and I practice with. I need to watch out for this fair value gap right here though, because it can, it could potentially reverse from there and come down to this low. So if price don't make it above that, I'll get out of this trade and I'll get into a short, and this will be my new take profit. So I need to make sure I monitor this area real quick. I needed to get above this. Once this candlestick, if it closes above this, meaning it leaves a body of the candle above here, then that's sentiment that price want to go ahead and continue going up. So I'll keep an eye out on that candlestick right now. Either that candlestick or the next one. So I'm gonna drop down the lower time frame and see what kind of price action is going on here. Because this is the 15-minute chart, meaning each one of these candlesticks represent the price movement in 15 minutes. So I'm gonna drop down to the 1 minute so I can see what's going on in here. I have a little more information. The fact that it reversed hard like that, this thing might want to go down. What time is it? It's 10 o'clock. We're gonna watch it. I'm actually gonna move my stop loss up here, just in case if I am wrong, it'll stop me out in profit. But this is pretty much what I do. The time window that I have to execute is from this line. If I don't see a setup happen between these two, then I wait for a setup to happen between this one and this one. And what I look for is displacement to one direction after breaking a recent high or a recent low. I want to see displacement and a fair value gap, and then price will come back down into that fair value gap, and that's what I enter in. So right now, if this candlestick close above here with a lot of momentum and I leave a gap, that's 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 evidence that that's the direction that it wants to go. They still haven't left a fair value gap yet. This right here is called a wick when it's just a long skinny line. And wick is usually a form of manipulation to where price would just trick people into getting in a buy. Or it also takes out the liquidity above these highs. So what I want to see is something like this, where it's a large body of a candle that went past it and closed. But I want to see this to the upside. This right here would be the candle, the high I would want to see that happen with now, if it's gonna happen. Seeing this, it looks like it's a lot of manipulation, and that could be an indication that price wants to go down. But I'm still gonna hold on to my original bias and keep my stop loss here and just wait it out. There's liquidity above this one. There's liquidity above the London session. This is the trading that happened during the London hours. And these two highs being close like this is something called relative equal highs, meaning there's extra liquidity there with another high. So it's a good chance price wants to run up here. This game takes a lot of patience. A lot of patience. Usually, if my trade don't happen by 11 o'clock New York time, I'll get out of the trade and go on about my day. Back in the day, I used to sit in front of these charts literally all day, watching every candlestick print. All right, so this right here is a fair value gap. this is something I can enter on. I'm not going to enter on it because I already got into a position down here, but this right here is confirmation that price want to continue up. So what my trade would look like if I wasn't already in the trade was this. This is called my Fibonacci retracement tool. I pull that out. I find the 50% of that candle. I will have my limit order right at the top of that. Right at the 50% of the fair value gap. And my stop loss will be under the candle that left the fair value gap, which is right there. And then my take profit will be 3 times my risk. So my risk is 1, and this is my profit. So I will wait for price to come back down to this area, and I'll have an entry limit here, stop loss there, take profit there. So I would just wait for this to come back. It actually left another fair value gap here. If this candlestick closed and leave this gap open, this right here would probably be the better entry because it just took out this high. Took that high out, which I call a breaker structure. And this right here is my setup that I look for over and over and over again. So this right here would be the trade. So I will move this up here. Now I actually move my stop loss down here because this is another fair value gap. So price could come down and tap into this fair value gap also, but this right here would be a higher probability trade to take. And I'll go ahead and move my risk to reward up to 3. And that'll be my trade. I'm gonna actually go ahead and get another position in right here. Take profit there. My stop loss will be down here. Now go ahead and buy that. Now I just sit and wait for it to happen. $23.77. And if price don't come down here, before I used to feel like I missed out, but now this stuff happens so many times. I don't even, it don't even affect me that I missed it, so to say, because there's more that's gonna come later. So, but before I didn't know what I was doing at all. Okay, so this high right here was just taken. So this is hostile liquidity that was taken. So I would expect price to go ahead and retrace back down to here now. After taking this, it could go up and take out the London highs that I was talking about earlier, this liquidity, before retracing down. But if it was to retrace, I would expect it to do it from here. But if not, I'm still cool either way because I'm still in a position from down here. So whatever happens up here doesn't really matter. So let's reach for these highs. I called that it was coming up here when price was still way down here doing all of this messy stuff like that. This this algorithm is it does what it does. A lot of people on YouTube say that there's no algorithm and that price is random, and like nobody can predict where price is going to go before it goes there, and like it's that's not the truth. The people that say that just don't understand the algorithm. They don't know how to read it. They don't know what they're looking at, and they're just getting in, pushing buttons, and hoping that it goes their way. But when you understand how algorithm work, you can anticipate and pretty much wait for your setup, wait for price to come to you instead of chasing price. There's a lot of people that would be buying right now while this is running up, uh, trying to not miss out. It's something called FOMO, fear of missing out. But to prevent that, you have to know basically what it is that the algorithm is seeking and looking for. And the main two things that it looks for is liquidity above or below um, price action or below market, and it also look for inefficiencies like these fair value gaps that's in between the liquidity above or below market. So the fact that we just took this out, we took all of this liquidity out, there's a good chance that it's going to come back down and seek this inefficiency down here that it left. Let me move it over. Oops. There we go. All right, so this is 1 minute. Oops. Fair value gap. I know this probably sound like another language right now, but it, over time, it'll be understood. It took me years to get where I'm at. And this down here is something I don't use too much. I just like to use it as a barometer to basically as another confluence that go along with what it is that I'm seeing in price action already. And what it is when price gets up here above this, above the 70, then that means it's overbought. And usually when the market is overbought, it'll retrace. When price gets under here, I mean it's oversold. Like let's see, like here, this came under this line, so this was oversold. So usually it'll reverse from there, and you see exactly what price did. Price was down here, coinciding with this oversold indicator, or um, I don't know, it's showing that it was oversold, and then price reversed and ran up. Now it's showing that it's overbought. So that goes along with the fact that it just took out these highs, took out this high, and it left this gap. So this is a place where I would expect price to come back down to. Now it don't always follow the logic of this overbought, oversold indicator. So I don't base my trade solely on that. Like I wouldn't just hit sell because I see this is over that line. Back in the day, I used to do that. There were some people on YouTube that swore by the accuracy of this indicator, and that's not it's not what it is at all. You can use it as a good barometer though, for sure. That's about it. All right, so this right here is something called an order block. This is a little guy, but this right here is the last down close candle before a big up move. So if this isn't going to come down, it will come down and tap this and then continue to run up. So I usually mark these up, but I don't like to have too much on the charts because then it starts hiding the price section. But my mentor consider these like bookmarks in a and look like the wick came down and tapped the wick. It usually come and tap the body, the top of this box, but it can do the wick also. I'm still expecting it to come down here. Let's see what it do here. If it blow past this, the order block right here, this right here would be the target. There's hardly any inefficiencies up in here except for one little one here, which is the one that took out this high. So that's the potential spot it could tap and run up, but I wouldn't take that as an entry. With this being a potential spot for price to come to, so getting in here, knowing that it can possibly come down here, that'd be way too much risk, and I wouldn't want to have that much risk on a trade. So if it came and tapped this and took off, I wouldn't be upset that I missed that trade. It is what it is. This is my setup, my model that I look for. It don't work all the time, but majority of the time it does work. And trading is a probabilities game, and that's what having a set of rules and having a strategy, having something that you know that repeats over and over and over again, and you can get stats on it, is the difference from getting in these markets and gambling and actually trading with sound logic. So a lot of people call this gambling, but those are the ones that just get in and just they will be buying up here just because price is moving up. Like that's somebody that don't have an edge, they don't have a strategy, they don't have a set of rules, and they don't have control. So with it being a probabilities game, with me having back tested this logic and this strategy for yeah, like for over a year with this set strategy, I know how many times it worked on a percentage base versus how many times it don't work. So understanding that, I'm not worried if it don't tap me in on this one. Fridays are days I don't trade, and that's why I'm not trading today. This is just this is the demo, and like I said, I like to still watch price action and have my subconscious record this information basically, just to get more experience. The more experience you get, the easier it is to do this. So I still get in front of these charts even on days that I don't like. Mondays and Fridays, I do not like. The most amount of damage was done on those days, and it's usually because that's when the most amount of manipulation happens. Tuesday, Wednesday, Thursday is when wherever the market want to go, it'll use those 3 days to get there. But Monday, it's first day after the weekend. Everybody, it's not. Don't nobody like to go to work on Monday, so it shows in the markets too. And Fridays, everybody is getting ready for the weekend. They trying to get up out of there. So Mondays and Fridays be ugly. That's just from me having experience with those days and recognizing that that's when damage was done. So I tend to stay away on those days. So with this being a Friday, if this don't play out, I know that next week, you know what I mean, there's a greater chance using the probabilities that it's gonna work out. Let's say I got a statistic of out of 10 trades, 8 is gonna work. So this trade don't work, then I know I got one more that I can lose, and then I got 8 trades that's gonna go my way. So getting in with that logic, I don't mind losing a trade. I know that it's gonna happen. You can't win all of them, so it's just falling in line with the stats, and that takes the edge off. That takes the anxiety out. It takes the fear out, and it gets all of the emotions out of the way. And you just get in these markets and trade like you're a robot essentially. You gotta straight detach emotionally because when there's emotions involved, I know firsthand, there's emotions involved, you will make mistakes. You will do something that you would not have done if you wasn't drunk in emotion. So the way to get emotions out of it is by making it like it's systematic. It's something that's almost automatic. Like you don't react or respond unless all of your parameters line up. If your parameters don't line up, there's no button that's pushed, and, there's nothing wrong with that. Back in the day, I used to think I had to be in every move, every trade, every time it was going up, I'm in a buy. Every time it's going down, I'm in a sell. And boy, oh boy, was damage done. So this right here, what it's doing now is something called consolidating. The markets do one of three things. Either it goes up, which is called bullish, or the market goes down, which is called bearish, or it goes sideways, which is called consolidating. And this is when you want to basically be out the way. When it goes sideways, is this seeking liquidity above and below price action. So there's a lot of information that's in the consolidation though, and it's easy to get caught up in it and get chopped up in it, trying to get in buys and sells. It's a messy game. But it does have a lot of information in it, because after the consolidation, you'll have something called the manipulation candle, and the manipulation candle looks it looks something like this right here. This right here is a consolidation, but in this candle right here was a manipulation. It went up and down, knocking out the liquidity above here, tricking people thinking that price is going to go up. So once it wicked up like that, came down, and this candle opened, I bet you a lot of people got in buys right here thinking that price was about to continue to run up from here. But then price came up and then dumped and grabbed this liquidity. It came down more. What did it tap into over here? Oh, it tapped into this order block down here. I'm going to drag this over. And this is actually why I got into a long, because it came down here and it didn't grab this liquidity, but it grabbed the liquidity under here and some other liquidity. Oh, in London. But then it came down here and started consolidating, and then it ran up and it broke structure here. And then I seen this big manipulation candle down here, and that gave me an indication that it wanted to run up. Also, the fact I seen these highs here, seen these highs. That's about it. This right here is as far as I expect it to go. If it goes higher than that, it is what it is. But my trade is done. I hit my target. The first trade that I was in. This one, I didn't get activated or tapped in on that one. That'll be all right. But the first trade that I was in from down here, this was my target, which were these highs above the Asia session. And See, price came right to that. So I would be done for the day. That's a good, solid day. Now, whatever happens the rest of the day, it is what it is. I did what I did and got out the way. So I would cancel that. That would be my day. And I can go back in price action and show this move over and over and over and over again. It repeats. This is all old price action. I'm gonna bring up another example real quick. Let's see here. I gotta find the right time. All right, 8, 9. All right, here we go. So 9:30 and then 10 o'clock. I gotta open this up. That's why I was going by so fast. And then 11 o'clock. Oh, that's a 15-second chart. All right, hold on. I gotta drop down. Put this box. So when I go to the 1 minute, it'll be easier for me to find that price section. Hopefully, I can go back that far on the 1 minute chart. Oh yeah, here we go. No. Oh yeah, it is it. Alright, we're gonna get rid of this. Alright, so how I would mark this up is this right here is sales on liquidity that was taken out. And this. Well, this would be the one to mark up. Actually, this right here would be the first trade that I would have taken and gotten out the way. So here's an inefficiency that price is in. So that's a fair value gap on the 1 minute. So price came up. The wick went above it, but the wick is what do the damage. The wicks it seeks buy stops and sell stops, and it knocked people out of trades, and that's the manipulation move. So the fact that the wick went up there, but there were no bodies that closed above this fair value gap, that shows this area as resistance, and it's doing its job of filling in this inefficiency over here. So seeing that, and the fact that it's at 9:30, which is the New York equity open for the AM session, that's usually when the volatility come in. So seeing that, seeing the resistance, the fair value gap, and then this displacement leg down, taking out all of this liquidity up under here and leaving a gap, this right here would be my entry signal. So I would mark this gap up as soon as it happens, like so. Let's see here. A minute. Where you got? And I would have my short position there. And stop loss would be above the candle that left the fair value gap. And then my trade would be a 3-to-1 risk to reward, meaning I'm risking $1 with this. So if I was wrong and price was to tap me in here and continue to go up, I only lost $1. Now if price go my way I've made $3. So you see, as you see here, price came up, tapped me in, and dumped. And that right there would have been my in and out move. I would have been done for the day. All of this price action, I wouldn't have been concerned with it because I already took my trade. This window from 9:30 to 10, that's when I would like to take the trade because it usually happens quick. I can get in and out, but this type of setup don't happen all the time at 9:30 at New York Open. Sometimes it'll just open and run and never return back into that gap. So when that happens, I'll wait for the 10 o'clock to 11 o'clock window of opportunity, and I will wait for something like this. This right here is another move. So this right here is my breaker structure move, which is ICT teaches this in its 2022 mentorship. It's a year-long course, but when I learned about this right here is when my understanding of the markets and price action really turned around. And that's when I needed to work on my psychology more than anything. Because I had the strategy, I just needed the discipline and learn about the emotions and everything. And I just had to deal with it and go through the pain. Like literally, that's the best way to learn. So what happens here is that price come down, take out these lows, come down, take out these lows, and this is called a trend. This is a structure. This is a bearish trend. When you have a high here, you have a low here, and the price come down, takes out this low, and it goes up, and it does not take out this high. So it goes up and it creates a new high, and then it creates a lower low, taking out this low. Now, if it continues to do that, then this would be considered a bearish trend still. But the fact that price took out this low, it created this low, and instead of making a newer low, it took out this high. So as soon as price take out the most recent high, that is considered a breaker structure. So when I see a breaker structure and I see it done with volatility, with momentum, meaning there's a strong push above it, that's a lot of pressure in that in a bullish direction, which is up. So seeing that it leaves a gap, that right there will be an area that I would be interested in entering in. So my trade setup will look like this. I will enter. First, let me explain what a fair value gap is. All right, the fair value gap is the bottom of this candle and the top of this candle. All of this action in between here is an inefficiency. The algorithm does not like to leave voids and inefficiencies behind. It like to come back and retest those and give large institutions the opportunity to buy at this cheaper price before running up. So understanding that that's how smart money trades, I want to get in when they get in. It's basically like how surfers know that the waves are coming, but they can't just get in there and make the wave do what it do. They gotta wait for the wave to come to them, and they hop on that big wave and ride it. So me waiting for this right here is this is a big wave. I want to hop on that and jump on it and capitalize off of it just like everybody else is. So let me mark this up. 1 minute. So my trade will look like I would enter on the bottom of this candlestick, which is the top of the fair value gap. And then the candlestick that left the fair value gap, I will put my stop loss under it, because if this fair value gap is valid, price should not come under the wick or the lowest end of the candlestick that left the fair value gap. So whatever my risk is, my reward is 3 times that. And as you see, that would have been another clean trade. So if I wanted to take 2 trades that day, that's what it would have looked like. But once I would have got this, I would have got out the way and went on about my day and not even been watching this. I just come back to this after price did what it did, and I analyze it and mark it up just to see what would happen and to get more data basically as far as adding to um, the data bank that I'm collecting to get more information for the probabilities. The more trades I take, like using old price action, the better and more accurate the probabilities are. So let's see what's going on with the trade that happened today. Took out those highs and it's just hanging out right there. My trade would have been done right here. So now it's consolidating after taking out those highs. So this right here is the area that it could definitely reverse from. It done took out a lot of highs. We got this high, and these. And New York PM session from yesterday. So this right here would be an area. If I wanted to take a trade, I could wait for a break of structure right here under this low. This would be a break of structure. Bottom. I would wait for it to break that, and I would wait for it to leave. I would expect it to leave a fair value gap. And then I would wait for price to come back up into that fair value gap, and I'll enter a short, and it'd be a 3-to-1. But I would expect price to come all the way back down to here. So it's still within the window that I have to trade also. But again, this is Friday. I don't like Fridays. Not for trading. Friday is a good day. I mean, all days are good days. Any day that we wake up, but for trading, all right. So here's a baby fair value gap that it's respecting. It looks like. All right, there. So if this gap is valid, price should not come under this low. So we're gonna watch that to see what happens. Price come under here, then it's gonna come and violate that low for sure. Drop down to the 15-second chart, get a little more information. There's a big fair value gap on the 15-second chart. Another gap. Break a structure right here. Gap. Price coming to it. Runs up. Come back. Dig a little deeper. Tap into this fair value gap. And it runs up from there. This right here could have been a trade. I'm on a 15-second trade. Could have got in right here. Oops. Stop loss over there. Oh, that one wouldn't have been profitable yet. It was close, but not yet. There's a break of structure. Fair value gap right here. Right there could have been an entry to the downside. So this is the one I'm looking for on the 1 minute chart to look for a sell. Grab the sell solid liquidity. So this 1 minute fair value gap is not valid. So it's gonna come for this now. And this is the one that I want to see it leave a fair value gap on, and that'll be the one that I would enter a sell on. So I want to see this candlestick push hard past this one and not just hang around this area. I want to see it dump pretty hard, a lot of momentum, a lot of volume, just a lot of strength to the downside. If it just leaves a wick, then I mean that this was just a liquidity grab and it can turn around and run up from there. So that's why I said I want to see it push down hard and leave a strong candle like this past it. So if this candle or the next candle would have to push strong past it for this to be considered a break of structure. If not, then it was just a liquidity grab. Yeah, this candle here will have to push down and close lower, meaning not just leaving a wick like this. Like this candle, it closed above it, and this wick, the wick is what did the damage, and the body is what told the story. So this one will have to close, leaving a candle like this, but below this line, in order for this to be a break of structure. This is the fair value gap that I could potentially use, but I would rather this candle be the one to leave the fair value gap because this would be the one that closed below it. So this could be a setup, but it's not a high probability setup. So it's not one I would take. Plus, I've already got in and out of my trade, so I wouldn't still be here doing this. Just showing examples in the live price section. Okay, so now this one closed under it. So this gap would be the one that I would use to enter on. So it'll look like this. Entry there. Stop loss above here because of this gap here. Price can come back into that, but it should not go above the high of this fair value gap. But I would prefer it to come in, tap in here, and not go above here. But it could wick into that. And it'd be a 3-to-1. So it'll look like that. In fact, I'll go ahead and take it on the demo. All right, so price tapped in. Like I said, it can potentially come up here and wick up there, but I don't want to see a body close inside of here. I would just like to see a wick if it did go that high. I really don't want it to go above here. Now I have to watch this area because this right here is an order block. It could tap this and run up, or what I would expect it to do right now is to just blow past it, come back up, retest it, and then go ahead and continue down. But it's going to have some resistance here because there was a lot of buying that happened in this area. So it's definitely going to play around this area for a little minute. But it'll eventually just blow past it. There we go. So blew past it. Now it's going to come back up, retouch it, and then go ahead and continue down. There's a little fair value gap right here. Might act as a little resistance, but not much. Looks like it's about to smack the target now. Came back up and did immediate rebalance with the bottom of that candlestick. So filled in that little gap. Now I want to tap this. That's funny. All right, so being this far in profit, usually what I would do if I was in this trade is I would bring my stop loss to some profit, just in case if this trade completely turns around, it won't be a losing trade. It won't be a winning trade like this target, but at least it won't be a loser. So this right here would be considered a bearish order block. This is the last up close candle right before a big down run. So expect this candle or the candle after to push down pretty hard. See, this candlestick came back up into this order block here. Came back up, tapped it. Now I can go ahead and run down. People say that it's not an algorithm. Look, the trade would have been done. That trade would have been done. This trade would have been a loser. I would have lost this little amount, but I would have gained this amount. But I would have been in this trade because, like I said, all of this buying has already happened. There's highs over here that has been taken out. These highs, I wouldn't have been looking for buys up here at all. This is the setup I would have been looking for. As soon as I would have seen this weakness after this liquidity had been ran, I would have been looking for shorts back into this area. So this right here is the original trade. So this is where I would expect price to come back to, because this is the early morning, which is the beginning of the 10 o'clock session, fair value gap or inefficiency. And like I said, price seeks one or two things: liquidity above or below the market, or inefficiencies in between the liquidity above and below market. Those are the two things that price or that the algorithm looks for. So understanding those factors, there's no reason to be in any buys up here once this liquidity is already ran. And then you see price consolidating and hanging out in this area. They don't want to continue up if it's sitting there just chilling, hanging out. So, well, that's it. I'm about to get ready for work now. Got this out the way. That's it. All right. Well, now you see my session. Oh, wow, that was a whole hour. Oh, I've been bumping my gums for a minute. All right, I have to end this.